since our mid-year update, the investment environment has become much more challenging as earnings growth is slowing and worries about high inflation have intensified. Price pressures may remain higher for longer than expected, given significant supply-side bottlenecks, a global energy shortage, and rising wages. Geopolitical shifts have also created significant uncertainties as China's regulatory crackdown on firms making excessive profits has resulted in poor equity market performance, especially across Asia in Q3. Well, the prospect of inflation being too high for too long increases the risk that it will eventually cause a slump in growth, especially if households postpone their spending and if firms cut their output to try and contain costs. The chart shows that earnings growth expectations have peaked and are likely to slow further from here. Global equity returns have also slowed, but are still quite strong and above average. At the same time, inflation has surged with supply-side bottlenecks. While inflation will eventually normalise as forecasters expect, there is a risk that we get a repeat of the 2011 experience, when inflation was last running at 5% per annum and equity returns fell and earnings growth slumped. Well, investors need to remain selective and cautious over this transition period where above-trend growth is slowing, inflation has jumped rapidly, and monetary conditions will eventually tighten. There is likely to be increased bouts of volatility, but growth assets like equities and real estate should be able to generate returns in excess of inflation. We remain positive on global equities because even though growth is slowing, earnings expectations are still significantly above trend, especially across developed markets. Well, our global risk appetite indicator also remains positive, which should continue to underpin equity returns even as they ease over time. However, we have shifted to a negative outlook on Asia and Chinese equities because of the significant downside risks to growth and uncertainties created by China's regulatory crackdown. There are still attractive opportunities from the bottom-up perspective, and we still favour sectors like consumer products, communications, healthcare and renewables because they seem well positioned to withstand this challenging macro backdrop.